In the investing world, there's a lot of talk about commodities. To think about them more simply, they're really the building blocks to so many things in our life, from food and fuel to electronics. But for an investor, it's important to think about them slightly differently than stocks and bonds. Historically, they've traded differently. That can actually be a hedge for investors. And speaking of hedges, these days a lot of people are talking about inflation, and commodities can play a key role on that front as well. For more perspective, we're joined by Brooke, research analyst at Global X, who does a lot of work on commodities. Brooke, it's always great to see you.
Well, it's great to be here.
And you've done a lot of work on a big theme we've been hearing more and more about in the market, the commodity supercycle potential. Can you talk to us a little bit about what you've been finding?
Yeah, well, there's a supercycle. It looks like it's been developing, and that's really based upon the demand increasing for commodities. And it's coming from the electrification of the grid that's taking place, and also the demand for critical minerals as well. Those are the two big components of that. And we're finding commodities such as lithium, silver, uranium, all having increased demand. And we're starting to see this being reflected in price. And this can continue for many years. It's not just a short-term cycle. Commodity supercycle really is something that can go past a typical business cycle. And we're also seeing some shortages develop as well, which is helping these commodities actually perform quite well.
All right, so as we go through this conversation, Brooke, we're going to talk about all sorts of commodities that tie into those big themes you highlighted. But let's start with the story of gold, the yellow metal, which has gotten so much attention, it feels like, especially in the last year. What are you seeing when it comes to gold right now? What are the charts and the numbers telling us?
One of the bigger drivers for gold has been the increased buying from central banks. And we've seen China buy gold 17 months in a row. They bought 74 million ounces. It's $342 billion worth of gold. And so this has been a continuous progress that we've seen with this over time. One of the big drivers from this as well, it's not only just the central banks buying this, it's also individual investors. And why is the buying going on? It's really, a lot of it comes down to currency debasement. You're just finding a lot of governments going deeper and deeper into debt, spending more and more money. And investors are starting to get concerned. And so they're investing in gold because of currency debasement, as the currency becomes worth less.
That's great context on some of the drivers for gold. People may have noticed with all the momentum, we did then see a bit of a stall out for the price of gold. So what's been happening on the charts?
Well, we've seen gold do extremely well, as you said, and just like other sectors of the market, like technology, you can see run up really strongly and then pull back for a bit. Gold has had the same phenomenon taking place. It got ahead of itself on a technical basis. And what we can see is, that gold typically rallies, consolidates for a while, rallies again, then consolidates again. And we're probably in that consolidation phase at this point.
Okay, Brooke, now let's move from gold to silver. I assume some of the buying trends for silver align with why people were interested in gold, but there are some differences. I mean, I said earlier, electronics is one of the things that comes out of the commodities that are available, including silver. So walk us through the dynamics with the silver trade right now.
Yeah, so silver and gold are both considered precious metals, but silver's a little bit different because it has a large industrial base use. So 60% of the silver that's produced gets consumed for industrial purposes. That compares to gold, which is around 6%. So there's a much different driver as well. So it's got the benefits of being diversified in both industrial and precious metals as well.
Meanwhile, Brooke, I had heard that there's not as much silver available actually in terms of supply to match the demand. What's been going on there?
Well, first of all, the background on this is that silver has been in a deficit position for the last 5 years and is expected to be in a deficit position again in 2026. So we're seeing a shortage develop. On top of that, we're seeing mine production slip in 2026 by 2%. So we're seeing the deficit increase by 15% to an amount of 46 million ounces.
And just a final question on this, because when people are looking at the stock market, they look at valuations of stocks. If you're trying to get a handle on the valuation of silver versus something else, something like gold, which we just talked about, what are some of the tools that people can use?
One of the tools is the gold to silver ratio, how expensive gold is relative to silver. And if you take a look, there's a historical relationship between that. So if you measure over time, over the last 30 years, the gold to silver ratio has been 65. And that means that an ounce of gold costs 65 times as much as an ounce of silver. Currently, that's at 90. So gold is much more expensive than silver has been historically. So there could be an opportunity for silver to actually do quite well relative to gold. And a lot of investors want to take advantage of this because silver is considered the poor man's gold. It's a much lower value. So we could see investors really come in and push silver higher.
Okay, Brooke, let's move from the poor man's gold to the AI boom, which has a lot of people talking about some other commodities because of all this power demand. In particular, uranium and copper get a lot of headlines these days. So let's start with the copper story.
Well, copper, it's been on huge demand and it keeps increasing over time because what we're seeing is we're seeing three key drivers. We're seeing the electrification of the grid. We're seeing clean energy also drive it, as well as more recently, AI. AI has been a huge driver for that because a lot of the data centers use huge amounts of copper. It's not just the data centers. Now you have to build the infrastructure around that with the wires, etc. And if we take a look at Avison & Young, a real estate firm, they've predicted that by 2030 that we'll see a tripling of the demand for copper, or I should say the demand for power. And we're seeing this increase dramatically over time. And that's going to come back to copper. You need copper to be able to do this. And there's not enough copper being mined at this time for that. Plus, here's a really interesting stat. The data centers are going to consume so much power by 2035. It's 100 gigawatts of power. That's equivalent to 20 New York City's consumption of electricity.
Okay, and earlier, Brooke, we talked about the deficit story for silver. So let's talk about the deficit story for copper. What's that looking like?
There's a deficit for copper now, and we're expecting a deficit next year and the following year and the following year, and it's expected to get wider and wider. The mines are going to take 10 to 15 years to build out, and this is going to be a huge problem down the road. So what we're finding is we're finding governments around the world starting to put copper onto their critical list for minerals. And so this is also going to encourage more hoarding of copper as governments start to build their own stockpiles for this. All of this is bullish for copper over the long term.
Okay, Brooke, so let's move on from copper to uranium. And we were saying earlier, I mean, this is part of this AI boom as well.
There are two broad forces that are really driving uranium. One is energy security, because countries around the world are looking for energy security. And also as well, we're finding that the demand for energy is increasing because of AI a lot. And so these two factors are driving the need for uranium over time. In the past, what we've seen is we've seen governments cut back on uranium for political reasons, but now it's largely considered to be a green source for power. And so we're starting to see that more and more purchases of uranium with government encouraging that, basically. And that's helping drive it forward. And AI is going to demand that because there's really no other way that we can actually help fund or supply AI with all the power in the long term down the road. And if you look at what's happened recently, we've seen 6 large tech companies in Q4 of 2025 spend a collective $700 billion on data centers alone.
And actually, we should probably also point out that weak prices in the past for uranium have actually played a role in the demand-supply imbalance.
Yes, and supply, it has an impact on price because demand and supply has equilibrium for price, of course. But if we go back and take a look at what's happened with price, it has affected supply with uranium. So if we go back to 2011, that's when Fukushima reactors, we had that problem in Japan. And then after that, there was a worldwide movement, a little bit against uranium and nuclear power. And we saw the nuclear companies respond by producing less nuclear facilities, governments not supporting them as much. We also saw the uranium companies not mine as much uranium. Now that's all changed. We've now said that uranium and nuclear power is clean energy. So we're seeing this now demand picking up. But the thing is we've cut back the supply, and that's going to take a long time to fix. You can't build a uranium mine overnight. It takes 10 to 15 years. So we know what we want, but it's going to take a while to get there. If we go back and take a look at what happened to the price of uranium in earlier in 2002 to 2007, which was a previous commodity supercycle, the uranium price went skyrocketing month after month after month, like so many other commodities, but uranium did particularly well in this cycle. And if we are in a good commodity cycle here, again, starting off, we could see uranium also do this phenomenon, despite actually performing quite well since 2021.
All right, Brooke, let's move to another commodity where there are a lot of other considerations, different than what we were just talking about, but all in the headlines, the geopolitical uncertainty, the oil story, which has been front and center in 2026. Talk to us a little bit more about what's going on with oil.
Yeah, we've seen the commodities being disrupted because of the US, Israel, Iran war, and in particular, the most affected commodity, one of the most affected commodities is oil. And so 1/5 of the world's oil and liquid natural gas transit the Strait of Hormuz, and that's being disrupted. That's going to affect the price of oil. We've seen oil go up a lot, and well, it can still go higher from here. We've seen West Texas Intermediate go up over $100, and there are forecasts for the price of oil to move up 24% in 2026. That's if the hostilities end in May. But if the hostilities continue, well, it's very difficult to predict, but the price of oil could actually move up dramatically higher from here.
Okay, meanwhile, let's move from oil to natural gas. What's going on there?
Yeah, we're seeing huge demand for natural gas. We're seeing an increase. The forecast for natural gas increase is 25 billion cubic feet of natural gas extra being used per day by 2030. That's an increase of 27% compared to today. That's a huge amount of natural gas consumption. And AI is actually part of that story. Because AI, 40% of the power that's being used right now to drive AI is coming from natural gas.
Okay, Brooke, and our final commodity story is lithium. If people are watching on their phone, there's lithium battery technology. The lithium story is also important to the electric vehicle evolution as well. What's going on with lithium?
Well, first of all, lithium, if you take a look at for batteries for EV cars, 75% of the lithium that's produced gets consumed in batteries for EV cars. But it's not just about EV cars. It's also about batteries for other things, such as power stations. We're moving into this substantially. We're predicting a 1/3 increase in battery stations to help supply the grid with power. And overall, what we're seeing a deficit starting to happen for lithium. Canaccord Genuity says that we're moving into a deficit in 2026, and they're expecting this deficit to last until 2035.
All right, that was a great wrap of a lot of commodities that are deserving of attention right now, Brooke. And obviously people look at this area maybe for diversification, maybe as a hedge against inflation, but in terms of actually investing in it, are there ways for investors to access the commodity story?
Yes, there are. And one of the ways to do that is through ETFs. And Global X has just launched a trio of commodity funds.
Right, the Global X All-in-One Commodity Producers Equity ETF, COMX.
Yeah, that includes gold, silver, copper, uranium, and lithium.
Okay, and then there's the Global X All-in-One Commodity Producers Equity Covered Call ETF, which is CMCC.
That's for investors looking for monthly distributions and a covered call approach.
And then the Global X Enhanced All-in-One Commodity Producers Equity Covered Call ETF, which is CMCL.
And that's for investors looking for a covered call approach with leverage.
All right, Brooke, great information. Always good to chat. Thanks so much.
Oh, well, thank you very much. It's been a pleasure.
And thanks for watching. If you have any questions or comments about commodities, make sure to leave a comment and don't forget to subscribe so you don't miss our next investing video.